With the 10-year US Treasury rate plunging in early March and hovering around historic lows for the last 2 months, interest rates on both new commercial real estate acquisitions and refinances on currently owned properties are extremely low right now, which for most investors is considered a huge win to increase the profitability of a real estate deal. But as with any good thing, there are two sides of the coin here, and there are downsides to interest rates being this low, which don't get too much attention with all the news of cheap money floating around today on the internet. So in this video, we're going to break down two of the biggest potential pitfalls of the historically low interest rates that we're seeing today that you might not be thinking about if you're buying a new property or refinancing a deal right now. Hey, this is Justin from breakintoCRE.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial modeling. So if you're looking to break into the industry or do your first real estate investment deal, make sure to subscribe and hit the notification bell. So interest rates right now are getting ridiculously low on commercial real estate deals, with 3% rates becoming commonplace and even 2.5% rates on 10-year fixed rate debt showing up in the market. And on the surface, it seems like lower interest rates are always a good thing, right? Lower interest rates equal lower monthly payments, which equals higher cash flow and additional profit on your deal. But for commercial real estate investors, there are a few things to look out for with lower interest rates that might make you want to think twice about buying a deal just because of all of that cheap money out there in the market today. So the first thing that tends to be true across commercial and residential properties is that extremely low interest rates can significantly inflate property values. And the simplest way to think about this is actually using residential home buying as an example. So say you're looking to buy a home to purchase, and your maximum principal and interest payment that you want to pay on the loan on a monthly basis is going to be $2,500 per month. You plan to put a 20% down payment on the property, and you have a 30-year fully amortizing loan term. Then let's assume that you can take out a loan on the property at a 4% interest rate. Well, to produce a $2,500 per month payment at 4% interest, your maximum loan amount would be $523,653. And assuming that you make that 20% down payment, that means that before taking into account taxes and insurance, you could afford a home up to almost $655,000. But now what happens if interest rates drop significantly and that interest rate isn't 4% anymore, but just 2.75%? What happens to the maximum home price that you can afford? Well, with the target payment of $2,500 per month, you could now buy a home for $765,000, or a 17% increase in the total purchase price you could afford to pay with that 4% interest rate on your loan. And when this is happening to you, this means that other home buyers are also going to be experiencing the same thing, which means the market is going to be increasing their offer prices, and because of that, property values in the market will rise as a result. And just like the single-family home market has seen prices propped up by cheap debt, commercial real estate also has seen the same, even when you look at more sophisticated valuation strategies like solving for a target IRR or internal rate of return value. So for example, consider an investor that's targeting properties that can yield a 15% IRR or higher over a 10-year hold period. And let's say that investor is planning to buy a property with a $55,000 net operating income or NOI and expects that NOI to grow at 3% per year, expects that property to sell at a 6.0% exit cap rate at the end of year 10, and also plans to buy the property with a 70% LTV ratio upon acquisition. Now, for simplicity, let's also say this loan is interest only and the loan is made at a 4% interest rate. So with all that in mind, the investor can pay about $995,000 to acquire the property, and then based on those assumptions, that investor can expect to achieve that 15% IRR target on the deal. However, if that interest rate drops now to 2.75% like we used in the previous example, that IRR at a $995,000 purchase price jumps up to 17.4%, meaning that the investor can increase their offer price on the deal, in this case by up to $77,000, or almost an 8% increase over that $995,000 purchase price. And again, if all of your competitors are able to raise their offer prices and hit their returns, that means that commercial real estate values are going to increase as a result. Now you'll also notice that when we change the purchase price in this example from $995,000 to $1.072 million, the going in cap rate, or that cap rate upon acquisition, drops from 5.53% down to 5.13%, a full 40 basis point decrease. And with sale comparables for commercial properties taking into account cap rates, this means that lower interest rates will drive down cap rates in the market, which in turn means higher property values overall. And add that to the fact that with investors unable to find investment yield in paper assets like bonds with such low interest rates, this is also compounded by a flood of capital coming into the real estate market, seeking yield they can't find from other more traditional paper investments. Now, this is all great news for property sellers, but where this can get tricky is for buyers when properties are acquired during times of uncharacteristically low interest rates like we're seeing today. And you'll notice that when we increase the interest rate back to 4% from 2.75%, we see that IRR value drop to just under 12.5% for that same $1.072 million purchase price. Meaning that if interest rates are artificially low due to a short-term aggressive attempt to stimulate the economy like we're seeing today, a rise in interest rates in the future will likely cause cap rates to increase and subsequently property values to decrease. So if you're buying a property at a very low interest rate today and think you're getting a steal, when you turn around to go and sell that property, the interest rate picture might be much different for that next buyer, and the cap rate they assign to that property to value that deal might look significantly higher than your going in cap rate looked when you first acquired the property. This is why many commercial real estate investors will underwrite cap rate expansion today or assumed cap rate growth during their hold period, and this is likely going to be even more pronounced today with how low interest rates are currently. Now, this is all applicable if you're analyzing a deal that you plan to sell at some point, but what happens if you don't plan to sell the property at all and you plan to hold the property that you'd buy today long term? Well, unfortunately, you're not quite out of the weeds yet in this scenario either, because extremely low interest rates upon acquisition can expose you to something called refinance risk. Now, for commercial real estate loans, the typical loan term is somewhere between 3 years on the short end and about 10 years on the high end. But unlike home loans, where you'll generally see the amortization period or payoff schedule set as the same duration as the loan term, commercial loans generally have longer amortization periods than their corresponding loan terms, usually somewhere between 25 and 30 years. And because these loan payments are made on a 25 to 30 year payback schedule, but the full outstanding balance is due back in 3 to 10 years, this creates what's called a balloon payment, which is essentially one large sum owed at the end of the loan term to pay off the existing loan balance at the end of the loan. Now, if you're not planning to sell the property and you have a large outstanding loan balance that needs to be paid off, the only way to take care of this without dipping into your own pocket is by paying this off with refinance proceeds or the loan proceeds that you receive from a new loan. But if interest rates rise significantly over your acquisition loan term, that lender might have a much more difficult time getting comfortable with new loan proceeds that can actually cover your full acquisition loan payoff. This is because many lenders have certain debt service coverage or DSCR values that they require borrowers to hit on a new loan. And this metric essentially tells the lender how many times over the property's net operating income can cover the required loan payments on an annual basis, giving an indication to the lender of how much cushion the property has in its operating income before it starts to have trouble servicing debt. Now, this can vary depending on product type, leverage, the business plan, and several other factors, but lenders generally like to see this somewhere between 1.2 and 1.4x. So for our example purposes, let's set our DSCR requirement to 1.3x and see what happens in this example. So if we assume that we refinance the deal at the end of year 5 in that same analysis, assume the lender is sizing the loan based on year 6 projected net operating income, and assume that interest rates have risen up to 4.5% when we go to refinance, the maximum proceeds a lender would issue would be just $783,000, just $32,000 over the amount needed to pay off the acquisition loan at that $1.02 million purchase price. And if interest rates rise to 5%, the loan proceeds would actually not even be able to pay off the full existing loan balance, and the borrower would need to come out of pocket over $11,000 in order to pay off that acquisition loan in that case. Now, this could also be a concern if the property doesn't perform as well as projected and NOI values don't increase at the level you initially underwrote. Even at a 4.5% interest rate, if NOI growth drops to 1.5% per year from 3% that we assumed in the previous example, that borrower would need to come out of pocket with another $11,000 lump sum in order to pay off the acquisition loan. So at the end of the day, to make a long story short, while low interest rates can be excellent for sellers, looking to maximize the value of their properties today, and can have a lot of benefits for investors looking to acquire new properties or refinance right now. There are potential downsides of taking advantage of historically low interest rates if you're looking to buy a new deal in this market or looking to refinance. And the last thing you want to do is overpay for a deal just because you were able to take out a low interest rate loan, only to have property values drop a year later as interest rates rise. A very wise real estate investor once said to me, "You can always refinance, but you can't change your basis." And what that means is that your purchase price will always be your purchase price. And if you overpay for a deal, it's much harder to make that deal profitable than if you acquired a property with a high interest rate loan that you can ultimately refinance or pay off in full at some point in the future. Now, if you want to learn more about how debt affects returns, how loan payments, loan proceeds, and loan payoffs fit into a bigger real estate financial model when you're doing your analysis, make sure to check out the free Break into CRE Real Estate Financial Modeling Crash Course, and I'll link that in the description below. And if you want to learn how to build out models with more complex dynamic financing capabilities, like how to model a refinance in the first place, how to model floating rate debt, or how to model loans that fund construction costs during the loan term, make sure to check out Break into CRE Academy, which will give you instant access to 19 courses on real estate financial modeling and analysis, access to over 20 real estate financial models, and some additional one-on-one support from me. Now, if you like this video and want to see more content like this, make sure to let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.